very much. I can say I'm Dan Coatsworth, I'm investment analyst at AJ Bell. So what we will do now is talk you through some things. So we talked a little bit about disclaimer, same things here. Nothing I'm going to talk about tonight is advice. So, but I think before you think about filling your ISA with any investment at all, you really need to think about some core questions. And I think on your screen now you should see there's 6 things I think I'd like everyone to have a think about before they do anything. First of all, is why are you actually investing? I think this is really important. These questions are all interlinked. So we're going to talk about what's your risk appetite, what's your time frame, when do you actually need to get hold of that money, and if you've already started to invest, what's already in your portfolio, and are there any gaps to fill? So I think the key thing here is, the reason why I'm saying is, why should you establish why you're investing is, well, first of all, it's really important to have a goal. It acts as an incentive. Now, that might be saving up for your children's school or university fees. It might be that you're trying to save up some money to do up your house. It might be an extension or a loft conversion. It might be you want to go on a holiday of a lifetime. Of course, there's saving up for retirement, or you just simply might want to put some money away for the future, something that you can fall back on if life takes twists and turns. So I think it's really important to do that. Now, when you actually want to get hold of that money will actually determine which type of investment account you might want to use. Now, for example, if you're in, let's say that you're in your 30s and you're thinking about buying your first home, you might be attracted to the lifetime ISA because the government will give you a bonus contribution on top of what you're already paying. The key thing here is that if you're buying that first home using a lifetime ISA, that's fine. But if you're not using it to buy your first home and you think, okay, I just want to use it by like a normal investment account, I just want to dip in and get the money whenever I want, you must be aware that you get there's a 25% exit penalty unless you're age 60 or over. So there's little things like this you do have to think about. In that situation, perhaps if you want more flexibility, you're better off putting it into a stocks and shares ISA where there's complete freedom. There's no exit penalty on withdrawing money there. So in terms of how long you want to invest for, if you've got a short time on your side, for example, if you're only thinking about investing for, say, 2 or 3 years, you have to think that, is investing really right for me? If I was looking to, let's say, buy a home in 3 years' time, and the stock market goes through a bit of a wobble, as we've seen earlier this week, you do have to think about having time on your side to ride the ups and downs, let that stock market recover. But if you've got a much longer time period, it does give you more options, and perhaps you might be more willing to take more risks with your money in the hope that it will ride out any ups and downs. In terms of what's already in your portfolio, if you've already started to invest, I think there's a danger for lots of people to try and sort of just look to see what's doing well and think, okay, I'm just going to just buy all of that. Really, the importance of a good portfolio is to have diversification. Spread those risks around. I think you should really understand that investment portfolios all the different components shouldn't move together. It should be entirely normal for something to lagging behind something else, and of course it gives you that comfort that you'll spread those risks around, so you aren't completely reliant on one area to essentially keep your portfolio going. So if you've already got some stuff, think about, well, do I want to buy more of the things I've got, or do I really need to think hard about that diversification? For example, I might have all of my money in the US stock market, but really, would it be better if I spread that risk and think about other parts of the world, for example? So I'm just going to talk to you about the different types of funds you can get, because funds are an excellent way to get diversification because you have plenty of choice. So let me just bring this up now. Here we go. So the different types of funds that you can buy. via the AJBL platform, you can have ones that invest in different sectors. That might be healthcare, technology. This year we've seen lots of people interested in the defense sector. Now, there are specific funds for that. If you wanted to get exposure, you can get funds that are invest in different asset classes. For example, so a fund might invest in different shares, or it might invest in different types of bonds, or even property, or even you can get multi-asset funds that invest in a bit of some of all of them. You can get funds that invest in different parts of the world, whether that's Japan for a specific part of Asia, or broad cross section of Asia, or you really you name it, you can pretty much get exposure wherever you want. You can get funds that invest in certain types of companies, sort of high quality companies or dividend paying ones. Same for different types of bonds. It might be investment grade, high quality company bonds there. You can also invest in active or passive. So this is either active, being it's run by a fund manager. They're the ones making decisions, and their goal is to try to outperform the market. A passive fund, not run by a fund manager, it's essentially running following a series of rules, and it's just simply tracking the market, not trying to beat the market. Because you haven't got a fund manager's salary essentially be paying via your charges, you will find that the majority of passive funds are cheaper in terms of the annual charges that you pay. So I'm going to give you some examples about how to use this brilliant search tool that we offer for free on the AJBL website. If you want to find, for example, a passive ETF with exposure to US equities, some of you might watch this might be wondering what does that mean in plain English? It means a ETF is a tracker fund. It's going to be following a specific index or a basket of shares, and it wants to exposure to ones that are essentially listed on the US stock market. So what you should do is if you go onto the fund screener tool on the website, there's a button that says you can have a choice of funds, ETFs, shares, or investment trusts. So click ETF. Then you might want to go to the sector, and you can select North America. You can also select North American smaller companies if you want as well, to get exposure to smaller businesses. North America will give you companies predominantly they'll be much sort of medium and larger size. Yeah, so the next option, you don't have to do this. There's a Morningstar rating. So Morningstar is one of the data providers that we use. They score funds from 1 to 5, 5 being the best. So this is another way to sort of use someone else's hard work to help narrow down this universe. So just for the purposes of example, I've selected 5, the best rated ones from Morningstar. I've looked for ones that are less than 0.5% in terms of that annual charge you have to pay. And then I've just sorted the list by the ongoing fund charge. So I want the cheapest ones at the top. Now, you don't have to follow these rules. There's different ways to play around with it. But to give you an example, it brings up 3 of the list. These are 3 examples from the list of funds that meet this criteria. So we've got Wisdom Tree US Quality Dividend Growth ETF, the Invesco EQQQ Nasdaq 100 ETF, and there's a Spider one for US healthcare. So I mean, the names of the funds should be pretty obvious. So you've got US quality companies that grow their dividends, so particularly appealing to people who are interested in income. The Nasdaq 100 ETF, essentially tracking the basket of the Nasdaq 100, which is this is a tech-heavy index of 100 big companies in the American stock market, and the Spider one is tracking ones that are linked to the healthcare sector. Now, if you click on one of those fund names, you can see this is the type of information that you'd see when you're doing your research. So obviously, one of the things that people do like to know is like, okay, tell me what the top 10 holdings are of a fund. And you can see here for the Wisdom Tree Quality Dividend Growth one, you've got names like Microsoft, Coca-Cola, Procter and Gamble, just to get an idea of exactly where your money might be going. Now, if I give you a second example, let's say we want to look for an active fund with exposure to Europe, excluding the UK. So you go back to your fund screener on the AGBO website, click the funds, then go to the advanced filters and go into the sector where it says, click the one saying Europe excluding the UK. So because we want to find funds that are run by a fund manager rather than just a computer, we want to look for the active management style. I've selected 0.5 to 1% fund charge. This is typically what you might see for an active fund. They can be more expensive than that, and occasionally you do find ones cheaper. I've looked for funds that are £1 billion in size or a little bit larger, and then I looked for that five-star Morningstar rating. So you actually get 3 results from this, 2 of which are the same fund. So the Fidelity European ones, you get the AC and the INC. So for those of you watching the webinar who don't really understand what that is, the AC means accumulation. So it means that any dividends paid by this fund are automatically reinvested. The INC version will pay those dividends out into your investment account as cash. So we've got the Fidelity European. The other one on the list is the Line Trust European Dynamic. That's an INC fund as well. So that's just a very crude way of trying to talk you through how to use a screener. You can also look for things like a manager's track record. Do you understand the investment process? I think that's really important. If you're going to be putting money into a fund, you really understand what they're trying to do. You can look at other things like yield and the active share. How much does it really differ from the benchmark it's tracking? Sometimes you might just look at a fund name and think, okay, right, fine, I think I understand what it does. But I really would urge you to try and do a little bit more research even beyond that level. To give you a couple of examples, one is the Vanguard Global Equity Fund, and the other is the Fundsmith Global Equity Fund. I mean, if you just look at those names, they sound pretty similar, just have 2 different asset managers behind them. They essentially are investing in they're investing in stocks around the world. They are very different though. If you look at the top 10 holdings, you've got Meta, platforms, and Microsoft look like they're the same in both portfolios. Otherwise, portfolios are different. Now, the reason being is that Fundsmith will look for high quality companies, and it says it doesn't like to overpay, but that doesn't necessarily mean it's always looking for absolute bargains. And it says it likes to hold things for a very long time. Vanguard is slightly different in that it actually outsources the management of the fund to 2 different managers. One manager is tasked with finding their best ideas in sort of growth companies. The other side is a value manager. They're looking for real bargains on the market. And so I've got, if you think that if you in a rising market, you might expect sort of a growth biased fund to outperform, but something like the Vanguard one, because it's got growth and value, it does sort of help you hedge your bets if you're not sure how the market might be moving. When we come to investment trusts, it's kind of similar to when you're looking for a fund, but there are a couple of extra bits to consider. One is the discount and premium to net asset value, and that means is you can buy shares in investment trusts, and they often trade for less than the underlying value of their portfolio. Now, there's various reasons why that happens. Sometimes, actually quite rarely, you see them trading above at a premium, but discounts is all about the market's either thinking, okay, well, perhaps if they're in property, they're not actually sure that the stated value in their accounts is accurate for today, for what the market value might be. It might be smaller companies where there's a slight discount because of the market's saying, well, these aren't easy to sell if you had to liquidate your portfolio. But if you've not seen this before, it's well worth trying to get your head around. There's lots of stuff written on the HFL website about what this means. The other stuff with investment trusts is that they can actually borrow money to invest. That's called gearing. So in a rising market, they might be happy to take on more debt to extra money that they can use to invest. But of course, it works the other way. When you've got a downward market, having high gearing can actually amplify any losses. But it is a sort of a different factor that you find with traditional funds. So that'll give you a sort of an overview about how you might want to think about starting to do stuff. Just a few bits in conclusion is don't rush into buying the first thing you see. Just always do that proper research into it. Think about how each little bit would fit into your portfolio. Think of it like bits of puzzles and how they would sort of fit together. Do regularly review what you've got, make sure you're happy, but also, you know, make sure you're patient. Don't keep trading in and out of stuff, because investing is a very long-term thing, and patience is very rewarding. So thank you very much for listening. Let's